This is how all the wealthy families and politicians are transferring generational wealth. Yeah. As long as it's investment property, it doesn't matter the type. So you can go into all these other, and that's why you have the TIC investments. That's why you have the DSTs. That's why you have, all these different setups that is still investment property.
It'd be my professional advice to always be in pursuit of the property you're going to buy well within the closing time frame of the selling property. It's an important topic. We do a lot of 1031 exchanges. You end up accumulating multiple houses as investments. 1031 is a key tool.
We refer to it as a cheat code. It's one of the few gifts, if not the biggest gift that the government actually gives us.
Welcome to another episode of Cashflow Quest, guys. We've been off for a little bit and we're glad to be back today. Today, we've got a special guest. His name is Aaron Kancevicious. Yep. He's the VP of Business Development for 1031 Specialists, and we're excited to dive into the logistics and the finite details of all things 1031 exchanges. So welcome. Thanks for being here today.
Thank you very much. I appreciate that.
Good nice to meet you and have you here.
Yeah.
I appreciate it. Well, nice being here. Thank you.
It's an important topic. We do a lot of 1031 exchanges. We did at least 4 or 5 this year.
Yeah.
And I think it's a big thing as we roll over like older holdings, older homes that have been held for rent or whatever, you name it. And you end up accumulating multiple houses as investments. 1031 is a key tool. So we'd love to hear you kind of how you got into the business and then what gets you fired up and excited about the 1031.
Yeah, absolutely. Yeah. And we refer to it as a cheat code that the government gives. It's one of the few gifts, if not the biggest gift that the government actually gives us.
Hey, I'll take it. It's a win.
Yeah, absolutely. Yeah. So we're always looking for those. So my background, I've been consulting with real estate over 25 years. And most of that actually was in the finance space. And a few years ago, I went and set up a brokerage inside of a 1031 company here locally up in Carlsbad. And because of my background, I'm very familiar with putting deals together, became the lead advisor. He was looking to retire and sell, which he did sell. And so I was starting up kind of my own thing. That was the Pinnacle 1031.
Okay.
When 1031 Specialists found me. So the partners of 1031 Specialists are ex-Goldman Sachs, ex-Ernst & Young professionals.
Okay.
Have set up an amazing platform, to really streamline 1031s, to make it more investor friendly, to make them very transparent. We bought a company in Orange County with over a 25-year history, so we have well over 30,000 investors that we've been able to help.
Nice.
Yes, and so now that's what I do. Is we're nationwide. But I live here locally in San Diego, so I do a lot of trainings, a lot of lunch and learns, a lot of help for realtors, for CPAs, financial planners, helping them understand the basics of it, but also some of the ins and outs and some of the myths and misconceptions around it.
Sure. And so you guys are an accommodator.
Yeah, so we're an accommodator or a qualified intermediary. The terms are kind of interchangeable. And so qualified intermediary or QI. So we facilitate the exchange, we consult on them, set them all up, hold the funds, and make sure everything's done right.
And I guess just to kind of jump into it for the listeners who have no idea what how a 1031 would transactionally kind of happen, why would you need an accommodator? Like, why would somebody
give us the basics just so we have it?
Exactly. So just in basic terms. So when you have an investor selling an investment property, instead of getting hit with the huge tax bill, they can put that into other investment property and not pay that capital gains bill in between. Now, to do that, the IRS requires what's called a qualified intermediary. So that's somebody, a neutral third party. It can't be their CPA or their agent, anybody that represents them. And it's somebody that's going to set up all the paperwork and hold the funds, actually, when that property sells. Once that investor touches it, it's very important. Otherwise, it's considered constructive receipt of the funds and they're going to get the tax bill. So we hold them securely. We have a whole process for that I can go through as well. But and then when they're in escrow on their next property or getting ready to close on that next property, then they instruct us to send the funds there and to close on that. So we make sure the paperwork's set up, they're meeting timelines, and that the funds are held safely.
So let's run through a hypothetical. Let's just say you have a rental home and it's $1 million, just to keep the math simple. You're going to net and profit $1 million clean. And so you're looking to sell it. Let's say then you have offers come in, you accept an offer and you're looking to close when's the appropriate time for somebody to call you guys
to start that exchange process?
Yep, exactly. Yeah. I'm going to say two points in time. The first time for them to actually call us and consult should be whenever they think about selling.
Yeah, before they list it.
Before they even list it, yes. And I can give some stories on that, why we can set up the exchange at the last minute. That itself isn't the issue.
Sure.
But oftentimes they have so many misconceptions, or maybe they're holding title a certain way, or they might have a partner, one wants to exchange, one doesn't.
Yeah.
There might be things that they have to know, where if they're doing it at the last minute, there may not be time to do all of that. So we consult as soon as they're thinking about selling. Setting up the exchange, though, is once they're actually under contract.
Yep.
So they're in escrow. That way we can collect all the information from escrow that we need, collect all the information from the investor that we need, and make sure everything's set up before closing. That is the drop dead date. It has to be set up before they actually close.
Amen. Let's double back. I think there's a golden nugget in here, which is planning is, I'd say, a big factor.
Right.
And I'd say the structure of how you hold title has also been a huge factor for us and our clients.
Yes.
So we've constantly been kind of scratching the surface on the fact that it seems like it would be better, and I'd like your opinion here, to hold title on a investment property in an LLC versus being held in your personal trust. And we see that a lot. And so that's where I'd say the golden nugget of this part, the particular point, is plan, and you can always reorg or drop it into an LLC, form a new LLC, and hold title before you list it. And it kind of changes the options on the back end.
And the personal trust could be the sole owner of that LLC, but having it held in an LLC gives you more optionality for an exchange.
That's been our experience.
Yeah. So what do you know about that?
Yeah. So there's a lot that we can unpack with that. But really at the bottom of it, what we're looking for when we're talking to an investor that's thinking about exchanging is who is the actual taxpayer that's holding it, right?
Yes.
And so if it's held in that LLC, might be a disregarded entity, or it might just be an add-on LLC, but there's an underlying taxpayer. That taxpayer has to stay the same.
Yes.
And where I've seen that people have gotten into trouble without realizing it is oftentimes there might be like a joint LLC, multi-member LLC. Well, that means that LLC is the taxpayer.
Yep.
And so that was one just recently that we ran into at the last minute, where an investor called me. They had been in escrow already for a couple months, mind you, and it kept getting delayed. Well, they were waiting till all the contingencies were done, and they want to make sure everything was set up before they set up the 1031, which setting it up is doesn't take a long time. We handle that very, very easily.
Sure.
Yeah, a few forms and some DocuSigns.
We get it all set up, get a few things signed, we get the bank account ready to hold the funds.
Right.
So what his question was, he goes, well, I have a partner in this. I want to exchange and he doesn't. Okay, so that immediately then what's the next question is, well, how are you guys holding title? Is it a joint LLC? Well, that LLC is the taxpayer. That means the LLC has to exchange unless they drop out of it, do what's called a drop and swap. But that's got to be done kind of planned out.
That's
right?
the planning for
That's the planning part that you're talking
asterisk
about.
around planning is that now you need to form separate holdings and make a clear kind of forward plan to do a drop and swap. You can't like willy-nilly a drop and swap.
You can't. Doing that at the last minute takes time involved. And there could even be perhaps a look back issue, especially in California, where if they did it at the last minute, the IRS could disregard it perhaps. Now, there was a case in New York where they actually allowed it at the last minute. They said, hey, that's fine. There's no time holding.
Okay.
So that's a good sign that things might change.
Yeah.
But in order to get it done, they still got to, dissolve that LLC or change it somehow and change the title. That takes a little bit of time and planning regardless.
Yeah.
Which he didn't have. And so it looked like it was going to be about a $240,000 tax hit. And that's just my rough based on his profit. And again, and his realtor was going to lose a purchase. He's only going to be able to get the sale. So those are some of the issues we run into when they're not planning ahead of time, for sure.
Agreed. So then let's run that
we'll keep
hypothetical all the way through. So they call you, they plan effectively, they go into escrow. There's a closing date that's coming. So you've already set up the docs, open the account in preparation for the closing.
Correct.
Closing occurs. You take it from there through finish.
Yeah, absolutely. So we set up, when we set up all the paperwork, one of the things that we do, we take the security of funds very, very important. We think we have the gold standard and the highest. So we actually set up a separate bank account for every single exchange.
Interesting.
with a qualified escrow agreement. So not just a bank account, but that qualified escrow agreement means it needs 3 different authorizations for anything to be moved out of that account. And for our authorization from our company, that there's actually 2 that has to authorize within it. So those funds cannot be moved or touched. And then when they're ready to close on their next property, so they have escrow paperwork for that one, we'll do the same thing, basically in reverse. We're going to contact the closing agent, get all the information, set up the paperwork for that. They authorize the close and the transfer of the funds. And what we've done now recently is we've bought in with a company. They have all these bank payment companies, that we have all these payments online all the time. Well, they have all the access of all the bank's information. And we can use that for wiring as another step of security. Cool. Before we go wiring funds off somewhere by accident.
Double checking that it's the correct place.
Yep, we run it all through there. All the contact information, the routing information, and it'll give a flag as to whether we need to double check anything before sending those funds off.
Yeah, that's helpful. Yeah.
And then those funds get sent off to to that escrow, and that way they can close on the property.
And so run through timeframes, which I feel like are like the big like I answer a lot of questions on this, the 45 days or the 6 months, and everyone kind of transposes the 2.
Right. Yes. And people always, I hear 90 days all the time.
You're like, no.
Yeah. I'm like, no, that's, And I'm like, it got started somewhere. I get asked it so much. Maybe there's something online that says it. I'm not sure, but I get asked 90 days all the time. So there's 2 main timeframes. I say really 3 because it has to be set up before it closes. So that's really the first time frame.
Yep.
Although the clock doesn't start until the actual close of the sale.
Sure.
From that point, it's like the gun goes off. It starts the clock 180 days to close on their next property or properties. It can be multiple properties. Mm-hmm. By day 45, that's the identification timeline. So if they haven't closed on anything yet and they're still looking at things, they do have to turn in a list of potential properties. There's a couple rules around how many, but by day 45, that list is kind of the final. They have to close on something that's on that list by day 180.
How many can you have on that list?
Good question. Yeah. So we hear 3 a lot, and some just assume it's only 3. But the reason the majority only lists 3 is anything on that list doesn't matter what the value is. So if they sell for $1 million, the total of all those values can be $100 million. Doesn't matter.
Sure. Yeah.
Now, if they list 4, once they add one more property to that, the IRS has what's called a 200% rule. And that means that the total value of everything on that list can't exceed 200% of the value of what they sold.
Okay.
So basically, it can't be more than double. So if they sold for $1 million, they're going to list 4 or more. It can't be more than $2 million worth of values on that list.
Interesting. Okay. I didn't know that distinction because we typically only identify 1 or 2, so I've never, not thought about that. Yes. So it's only 200% if you go to 4.
If you go to 4, that's exactly right.
And I think one more thing to kind of throw in there is when you say value, it's not net proceeds that you're necessarily holding in the accommodator's account. Is the value, the sales price, the value that was what the property was sold at, for clarification there for the listeners too.
That's correct.
And he's talking about value, 200% of the sales price of the asset that was sold.
That's correct. Yeah. So if you sell for $1 million and you're going to list 4 or more, then the total of those values can't exceed $2 million. And so just to break that down as to, well, how does that really work out? Well, if someone's going to, So to defer all your tax, you have to buy equal or greater value than what you sell. And so if someone's looking at a property or they're trying to replace it with a property that's that equal value, well, they're pretty much only going to list 3 properties. Right.
Yeah.
So the times that I've seen people list more than that, or for instance, there's a lot of investors in California taking their equity, $1 million in equity, and they're buying, 4 or more homes in other states, whether it's Texas, Florida, and so forth.
Okay.
And so there you might be able to buy, 6 properties for the same value that you just sold.
Sure.
So that's when usually we'll see ones be able to list 4 or more properties because they're buying smaller. They're buying several smaller properties.
Yeah, for 1.8, not to exceed 2 million, but they can get a bunch of them.
They get a bunch
under
of them.
2 million.
That's exactly right. Yeah.
But your point is, even if if he sold for $1 million and bought $1 million, they still could buy 4 or 5 properties if they're less purchase price than just total $1 million. People will do that. And then it doesn't exceed the 200% rule either.
Right. Yeah. Exactly. Yeah. They just have to be aware of those rules. And those are, again, some of the consulting things we kind of go with them up front. We ask them, what are you thinking of buying? Do you have something in mind?
Right.
Now, a lot of people the last couple of years already have had, because of the market, They usually have something in mind, at least, they're worried about that 45 days.
Yeah.
But there are those who have no idea still. I'm surprised. They're selling and not sure what they're going to get.
We have clients call us on the 44th day.
Really?
And it's like, you guys got to give us more time to plan than that, And so like, so we've thrown some of our properties on the list for them as like their third, just to be like, hey, if you guys end up coming in as a smaller tick, tenant-in-common owner with us and using that exchange, okay. But what we've found it to be is it's extremely complicated and legally expensive. Specifically expensive on the legal front to bring tenant-in-common owners in for the commercial side that we deal with.
Right.
So, anyways, we can keep going down. So, let's finish this. So then you completed. You've successfully identified within the 45 days.
Correct.
Haven't gone over. Let's just say you put 3 properties down, so you don't have any of the parameters there.
100% rule.
You're looking to buy a couple $1 million worth of real estate. You have $1 million in cash in the exchange account.
Correct.
And now you have, I think the funny thing is people think, kind of get the 6 months from there, or when does the 6 months start?
Right. Yeah. They can get that confused a little bit. So the 6 months is actually the total time frame of the exchange.
The 45 days is part of that 6 months. It's not 6 months plus 45 days. It's a total of 180 days.
That's exactly right. So if they want to break it all down, it's 45 days plus 135.
There you go.
It's I tell them, the 180 days is always, whether you're doing a standard or a reverse exchange, it's always 180 days.
Yes.
And your identification is the first 45 days of that.
Yes. Yeah.
So that is the need for the planning.
It's like the gun goes off and and everything starts on 6 months.
Yeah.
Within that 6 months, you got 45 days you have to identify, and then the remaining portion of time to close.
That's right. That's exactly right. An interesting thing, since we're talking on the identification, one of the questions that comes up is somebody might already have some properties they're looking at, making offers, and they think, well, how do I identify? They don't have to worry about it before day 45, which is a great thing. Like, you can write 100 offers.
Yes.
That doesn't count towards the 200% rule.
Right.
It's just if none of those have gone through and you have to turn in a list, that final list on day 45, that is when it counts.
Yeah. And I think for clarity too, if you put 3 properties to identify on your identification sheet, you have to close on one of those to suffice the exchange. Is that true?
Yeah, you have to close on something that's on that list.
Yes, because if for whatever reason those 3 that have been identified fall out and don't go forward, you're kind of in a bind if you've gone past that 45-day timeline.
That's exactly right. Okay. That's why what you said is a perfect strategy, is always maybe make that last one maybe an investment type of option where you can always fall back on it. Right. Yeah. But just knowing that ahead of time and thinking about it will help out go a long ways.
Yeah.
I think your point though, if you already have, let's say, something else in escrow, because ideally you find the replacement and you close quickly on both.
Right.
Because then you don't even have to worry about the time.
No.
And we just figured out this year, I don't think we had done it that well, I'd say that fast. And we didn't even have to identify.
Right.
Because we had something in escrow, we closed on the sale, and we purchased the up leg before 45 days.
That's right.
And it was done.
And it was done.
And we didn't have to ID.
Yeah. Which eliminates that.
And so Morgan was like, you don't even have to ID.
Yeah.
I'm like, perfect. That means we did our job.
Yeah.
Then,
that means you did your job.
Didn't even have to worry about it, and file that form.
Exactly.
So that's exactly it. Well, you'll be surprised how many people we hear that say they're not going to exchange because they're so worried about that 45-day.
It freaks people out.
It freaks people out. It puts them under stress.
I have to find something.
Yeah, I got to find something quick. I'll be under the gun. And I'm like, but you can plan ahead though, and at least try.
Yeah.
That's the government's telling you, here's an opportunity to not pay hundreds of thousands in tax.
And depending on the property you're selling, if you're already in escrow, you can always extend and kind of give yourself some more time, which we've done in the past. But sometimes when you have just a single family home or something else, like, people get excited and want to close, but sometimes, it's helpful if you can extend the close a little bit to buy yourself some more time on an exchange piece. Yeah.
Yes.
It happens all the time in the commercial realm.
Right.
Yeah.
It'd be my professional advice to always be in pursuit of the property you're going to buy, kind of well within the closing time frame of the selling property, just to give yourself additional time in addition to the 45 days.
That's exactly right.
If I don't have line of sight on the deal that we want to buy, before we close, like that's, I'm kind of bummed. I'm like starting to get to where I'm like, okay, I got to find something.
Right. Yeah.
But typically we're like maybe negotiating the terms of the contract and we close and then it's like, okay, we're good.
That's right. Yeah. But wholeheartedly agree. Yeah. That's the way to do it. Yeah. Be thinking of something ahead of time. You can be writing offers. You can have a list together ahead of time. So that's just a big distinction is yes, the time frame starts when you sell, but that's not when your planning has to start.
Right.
That's not when it should start.
And typically as a seller, you can plan in some extensions, maybe even 15 days or 30 days, couple of 15-day extensions on the purchase agreement when you sell that property.
Right.
And so that's been a huge help for us too. Typically buyers, if you're selling a good asset, will also work with you.
Right. Yeah, absolutely. And I've seen some, and we work with residential and commercial all the time. Mm-hmm. So, I've seen someone to do things with their deposits, even on their purchase property, right? Make it go hard at a certain time to extend that purchase and give them time to finish selling their property.
Yep.
Instead of setting up a reverse exchange, it's all a matter of timing, which one's going to close first. Right. So some just need that a little extra time selling sometimes. Yeah. So there's just different ways of putting that in the contract, absolutely, to give yourself the time that you need and make it work.
So a couple minutes ago, you brought up a reverse exchange. And I know that's a thing too. And we have experience doing one for a client of ours.
Oh, great.
But some people might go, wait a minute, I'm just getting to know what a 1031 exchange is forward. We call that. What's a reverse exchange? Can you help the listeners understand that a little bit?
Sure, absolutely. And just so they know as well, about 95% of exchanges are the forward or the standard exchange. Yes.
Yeah.
But there are times where the reverse comes up handy. And it is everything we've just said in reverse. You'd actually be buying your property first. Mm-hmm. So those clients where they have that perfect replacement property, they've been out looking, they've been doing their due diligence, but they found something before they've sold and they don't want to pass it up due to the market conditions or there's multiple offers, whatever it might be. And so they can buy that property first. Now that takes a little more preparation because of the setup, right? And the timing and how that works.
I noticed the pricing on your website is significantly more expensive to do a reverse. And I know why.
Yes.
It is so much more intensive on the setup side. And then I'll let you finish on the punchline of, but the accommodator and you guys, what do you guys call it instead of accommodator?
QI, qualified intermediary,
has to take title. So
that's
I'll let you unpack that.
Yeah, that's exactly right. So they're able to buy and then they have the whole 180 days to sell. But in order to set that up, what happens is the IRS doesn't allow you, though, to own both properties at the same time. So that's the reason why there has to be some finagling a little bit. The most common way of setting that up then is, so we have attorneys involved that help set everything up.
Do you have that in-house?
They're an extension of us. Yeah, we have an attorney firm that works with us.
That's helpful.
It's hugely helpful. Yeah, absolutely.
That is challenging piece for clients. Sometimes we're like, well, I don't know. My attorney doesn't know how, I don't have an attorney or my attorney doesn't do this,
That's exactly
specific.
Right. Yep. Yeah. So we're able to collect all the information from them. We have a call with the attorneys, just to review the deal. But what's happening is a new entity is being set up, called an exchange accommodation title holder or an EAT or an EAT. But that's being set up to basically park that new property that they're buying. And that EAT or that new entity actually has us as the QI as the sole member of it. Now, the investor is the manager of it. And there's a bunch of other contracts that are set up at the same time all around it, which allows that investor to control and operate that property as soon as they close. But we've parked it in that structure so that it then buys them time to sell their property. And then when that property sells, now what's happening is now it becomes a standard exchange at that point. And we're assigning over that EAT or that entity back over to the investor to complete the exchange. So that's why there's some, usually 2 to 3 weeks in advance is ideal, to get all that set up, to get the attorneys involved, make sure everything's set up. Correctly. And of course, escrow needs all of that as well ahead of time for title issues.
Right. And I think too, for clarification, when an investor does that and does a reverse, you actually need the cash to buy the property you're buying. And then you own the property that you want to sell, but you have to have the cash. You can't can't like borrow from the property you're planning to exchange to use the funds to buy that property.
There's
you
a
have
good question.
to have I guess I should confirm that.
Right.
That's my understanding. Is that right?
It makes it a little more challenging, but there's lenders that'll help. For sure.
Okay,
which
like
is
a bridge
great.
loan type product or something.
And the reason it makes it a challenge, of course, again, because it's not just that an LLC is buying it, but the QI is the member.
Yes.
So there are private lenders that understand the structure and already have bridge loans set up for it. And depending on how much equity is in that property that they're going to relinquish, or if they have a loan at all on it, they can either do the whole loan just on the new purchase property, or some will actually tap into both properties, do like a blanket type of loan for 12 to 24 months, even though, again, the whole timeline is only 180 days.
That sort of solidifies their repayment of the portion when they sell.
That's right.
It becomes another payoff.
That's right.
Huh. All right. Keep going. That's interesting.
That's exactly. Yeah. So there's some options. So we always tell that up front. Whenever someone starts asking about a reverse, is we ask that, do you have the means to buy that property first?
Right.
Because most of them are thinking they're just going to be able to get some standard loan. And so cash buyer for sure is going to simplify the whole thing.
Yeah.
Yes.
If they need a loan, then that's the next question. Do you have a lender that understands reverse exchanges? Have they ever done one before?
Right.
Because a lot of lenders want to say, oh, well, tell me what it is. We'll figure it out. And I'm like, no, that's not going to work.
No.
The structure needs to be significantly understood.
Yes.
You got to know it.
Yes.
Okay. So you work with a few lenders.
Yeah. So there's some lenders that are able to provide those. They have certain bridge loans already set up. And depending on really the transaction numbers, if they're going to have a large tax bill, well, it's going to make sense then because, of course, the rate's a little bit higher. There's higher fees.
Yep.
But they are available. And there's been some where they didn't have a loan on the relinquished property and they actually can almost get 100% financing. And now they're just paying the fees for the loan itself to close the deal and be able to park that property. So it works out great. If they have, several $100,000 tax bill, well, then it makes sense to get that type of loan.
Interesting. Do you know roughly what the pricing is?
I'm not a lender anymore. That's my background. They're usually, from what I hear, about 10% range for bridge loans. Yeah, maybe 2 points, 2.5 points. Things like that.
Yeah. Honestly, a great loan product though, because you can collateralize. It's really clean, from a lender's perspective.
Exactly.
And kind of what the equity is coming out.
Yeah.
Exactly.
So it's a good short-term loan product.
Yep. Yeah. And that's what they tell us. That's what's funny about it. They tell us, oh, yeah, it totally makes sense. Yeah, we understand it. And sure, we can do this real easy. And then all the others, look at it and don't know what to do with it. So it's, you just got to find those with the experience. Yeah. And they can make it happen.
I like that.
Well, we know who
we because we're bringing up most of the time now fractional ownership, tenant-in-common, 1031, a fractional 1031 reverse.
It adds a layer. It adds a layer.
Really challenging.
That's a whole other story.
That's a layer.
and we were when we did it, we were blessed with great clients that had the cash, to do their portion, fund it. But it was just a big runaround for everybody. So I'd say we're shying away from those. We're just going to do clean 1031s.
Sure.
And now our minimum is kind of creeping up because we now really have line of sight on the legal costs for us. To operate these commercial properties, commercial mortgages, typically Fannie Freddie mortgages. It's expensive to do the roll up of like all 3 or 4. We have, I think, a couple up to like 6 entities.
Right.
We then roll them into a really clean, fresh entity after 3 tax return years.
Oh, yeah.
And that is expensive.
Right.
Just to redo the structure, get a loan approval.
Yep.
And it shouldn't be a lot, but it is just because you have to spend attorney time.
Well, and the title of the property is changing. It goes from 6 tenant-in-common owners to 1.
It's just kind of a big legal runaround to complete it. And so our new minimum is more like $2 million, in inbound, where people call us and we'll accept that.
Right.
And then I'd say typically already a client with us, so that we know them.
That makes sense. That makes sense. Yeah.
Because I can get it on your side. It's more transactional. You guys are trying to do volume, from what I can tell. Is that
right?
accurate?
Yeah. Because any exchange can be, you have a number of factors. It can be, number of size, number of properties, all sorts of factors going on. And so, we're generally looking at just the volume of exchanges itself. Yeah, that's exactly right. How much it is inside really isn't too much of a concern for us.
So if we have a client that's wanting to sell a couple $1 million property, let's just say they're going to net 1.5 and they want to look at our deal or have some guidance, have some legal guidance and planning, that you guys do all of that.
Yeah. So the consulting, as far as the 1031 part, that's exactly right. Now, some questions they start asking will get down into maybe perhaps their particular tax situation or their particular structure that they're thinking about. And we can tell them, well, from a Turn 31 point of view, this is how it looks. Now you need to go talk to a specialist, for taxes, or maybe to an attorney, a real estate attorney, depending on the situation.
Because too, structurally how they're holding it currently and how they maybe want to go into an up-leg purchase structurally, like you have to make sure that taxpayer EIN or social security number stays the same in the structure. So, that's an important piece. And so sometimes people get excited and go, oh, I can do it simple, but they don't think through kind of structurally how that is going to be on the up leg per property purchase.
That's exactly right. They don't think of that. And also, when they're going into some TIC structures where they have debt on the relinquished property, they're not thinking that part through sometimes.
Yes. And then there's boot.
Yeah. There can be boot. And I had one where the seller was helping them buy into their project, doing a TIC structure. Yeah. But they hadn't considered that. It was like a friend or something. They thought, we'll help them out. But, but they didn't understand. And I was explaining to them the mortgage part of it. They have to meet the sales price and get a new mortgage.
Equivalent or greater. Yeah. Or you're paying boot on the difference.
Exactly. You're paying boot on the difference. Yeah. So if they have a mortgage, they're going to need a new mortgage or put their own cash into the deal. Right. Right. To replace the loan. But they got into that structuring and they started getting some issues trying to figure out how to do it. They already had a underlying loan on the property. So trying to provide another loan for the person was going to be an issue. Yeah. So those kind of things, that's where you start telling them, hey, from a 1031 perspective, this is what's needed. Now, how to structure it, that's where you need to, talk to your attorney and figure out how to make that happen. Exactly.
And boot is just another terminology for a tax. It's a tax that's paid. And there's 3 levels. We have like this spreadsheet that we use in our analyst in-house. It has purchase price, mortgage boot. What'd you say?
Mortgage boot.
Yeah, mortgage boot. And then what was the third one? There's 3. Cash.
So then it's additional cash needed to buy their pro rata share of purchase.
That's what it was.
Oh, I see. Yeah.
And or like if we're going into a new mobile home park, we set up reserves, we have CapEx, we have a whole bunch of budgeted items to complete the project and then operate it for 10 years, So we have a lot of additional cash that's typically needed in a standard deal. So what it did become difficult on the front end. Now we've solved that. Michael built a great spreadsheet for that. But you cannot use proceeds. You have to use proceeds to close. You can't end up with any proceeds when you close as additional proceeds left over, or that's boot.
That's the boot. Yeah, yes. Exactly.
So then when you're tenant in common, all of the, let's say, buckets of money or the legal buckets of money have to have the pro rata share of additional cash required.
Right.
Mm-hmm.
Or else you can create boot by not having them buy enough pro rata share.
That's right. Yeah,
so there's a whole, we had to build a model.
That's amazing. I'm super impressed.
Yeah. I'll give the credit to Michael Kissinger. So we call him our in-house quant, just to give him a bunch of crap. But he figured it out. And then with him and Andy, our CPA, we built that out and we offer it pretty clean now, but we are now seeing that it's a bigger cost. Long-term is the big thing.
Right.
To offer that as a service, and it's done well. We have a lot of interest in it, but it's like we realize it doesn't make sense to have these people come in for like minimum under $1 million.
Right.
It's more like $2 million.
Right.
There some calculation now we can have fun. It goes right into the lazy 1031 exchange or selling, taking the gain, offsetting gain with depreciation and the bonus depreciation that we now have back with Trump's bill he passed. So that's been huge because that kind of helped us. On the smaller stuff, we sell the lazy 1031 exchange because the legal cost is actually less than the taxes owed a lot of the times. Or maybe it's close enough
Right.
Where it's, within maybe $4 or $5 grand total for these several $100,000 exchanges.
Right.
But you get to clean up all of the legal crap that you didn't clean up before.
Yeah.
There's these old trusts, and there's the story that you're talking about where you have a partner and your partner wants to do this and your other partner wants to do that. And it's like, guys, you just need to take the money.
Yeah.
And distribute it.
Cooks in that kitchen, clean it up, just say goodbye. And
distribute the cash at closing, get your pro rata share in the same tax year. Put that money with us. You're going to get this X amount of depreciation. Yeah. Typically in mobile home parks, we're at 100% minimum. Right. Because we're buying a bunch of land with infrastructure and we don't own the homes.
Okay.
So it's hugely incentivized on mobile home parks to bonus depreciate the assets. And
Makes sense.
We get up to, when loans and things kind of settle on pricing, we'll probably get back to 125, 150% year one depreciation.
Oh, wow.
So we can offset all of the federal gains.
Yeah. In California, they don't always recognize it. So depending on what state you're in, they'd have to pay in this hypothetical some California tax. But sometimes, like Blake was saying, that tax that's owed to California isn't as much as the legal costs that would be associated with doing a 1031 exchange or another, different exchange. But
we're now going to start charging the tenant-in-common budget.
Yeah.
So when we have this whole transactional budget, each one of them has their own cost. Fresh cash. Yeah. When we just do normal clean raise on equity, that bucket of money isn't going to have a big legal roll-up bill. It will, but I don't want them to bear that. Right. It needs to be burdened. The burden needs to go on to the exchange people that forced that.
Right.
They benefited from the tax.
Yes.
And so I'm going to have the tax savings. And so we're going to have to budget and allocate accordingly.
Right.
Which gives us a clear line of sight on how much then it'll cost them.
Yes.
And with that cost, it's going to build our threshold of how much money we will take on those 1031 exchange tenant-in-common structures.
Yeah, I like that.
And how much tax, we can do a quick calc on how much tax they would be paying. And you can go like this. And then it's a structural dynamic.
Yeah.
How did they have it structured? Are they in an LLC? What I like about LLCs, if they did do that, or they called us and planned accordingly, or called you, depending on what they were up to, the LLC ownership guys, if they have a tax ID and they've held investment properties before, we can actually cycle them in as that same LLC, same tax ID as a tick. And it reduces the legal cost.
Right.
Because they already have an LLC. They're kind of already structured for it. Or better yet, we could potentially fold them into our new entity.
Right.
And they just hold their membership interest in that LLC.
Oh, okay.
And they don't have to be a tick.
Right.
But that's kind of dependent on how their ownership on the LLC is structured, I think.
Right. Yeah. No, I could see that. Well, I'm impressed with all the planning and how involved actually you're getting on that. So, and what you build with your modeling, so they even know their state tax structure as well, right? So,
yeah. Well, we've been trying to continue to get creative to help other clients, and it's becoming a thing where, and you probably see it talking to real estate agents or other people in the industry that are trying to learn more about how this process works. But a lot of people who are actively managing properties, they just get tired and they're done with it. And they're like, how do I get out without paying a ton in taxes and get creative with structure? And, in our model in mobile home parks, we're all about passive income and passive investing for our clients. And so they're like, well, how do I do this? And so we've had fun jumping in, talking to real estate attorneys and CPAs and guys like yourself to kind of learn further. But we're still learning things. I mean, it's like, the deeper you get and the more complex the structure is, we're still learning things, but we've gotten the tenant-in-common thing kind of down now. And we've learned we don't like reverses.
That's a good learning thing. Yeah. Well, you don't want to throw in an improvement exchange on top of that, then that's for sure.
You have to keep those. What we've learned is you got to keep those reverses and all that, and or you're spending some money and renovate. And keep those simple and siloed.
Exactly.
Simple
it's
is
going to
always
complicate
better.
everything and get just too far out. Yeah, exactly. Yeah.
There's a threshold of like, this is going to be too complex if we take that in.
That totally makes sense. Yeah. But it is great because there are a lot of landlords out there that are just done being landlords, but they have no idea what to do with it. Or first of all, they have no idea what their tax bill is really going to be.
Right. Which is why you have to talk to your CPA, because like, you know, there's a lot of variables that go into that calculation. And it really is specific to that individual's tax situation.
Right.
And so, you know, it's helpful to talk to a company like 1031 specialist to really get the understanding of like, okay, this is what it would look like. But then now I have all of these questions to go ask and confirm with my CPA.
That's exactly right. Yeah, there's too many. What it seems like is they learn from Google, right? And
Google is not specific enough to your situation. I think do you get that a lot?
I get that so often. Everyone's thinking, well, you know, I've had a lot of questions. I think I got them answered though. And one of just from the very start, they type in capital gains and they see 15%. And they think that's it. So, hey, I'm just going to sell and cash out. And they think they're just going to pay a few $1,000s in tax. Yeah. They're going to take all their money and put it in the bank and walk away and retire and not be a landlord anymore. Yeah. And then they get hit a whole following year, right? It's not when they actually file their return and report that sale that they get hit. And I know because I hear these all the time. We had a client tell me like, I wish I would have known about this 2 years ago. And he sold for 1.8. Reported it, and he paid $600,000 in tax the following year. So they don't understand. They're only looking at one of several layers of taxes.
Yeah. Right? Capital gains is just one IRS piece.
That's right.
And then what about the state? And that's probably 13.
13 for California. Then you have net investment income. Oh, and the 15, that could be 20 actually, depending on your tax bracket.
Yes.
Net investment income tax, another 3.8. Yeah. And then they always, especially unless they're experienced investors, they don't know about depreciation recapture.
Yeah.
Right. So 25% of what they've depreciated.
Their CPA behind really what their knowledge is over the first 4 or 5 years of ownership had been depreciating because they should. Right. Like when they first bought that property, but now they have hardly any basis.
So it's almost all gain. Yep. And now they're handing it all back to the IRS, and hopefully they hadn't spent the money at that point.
Well, exactly. Because to your point, the tax bill usually doesn't come for like a year.
A whole year later.
And so it happens where people spend the money when they don't understand. But we say internally, it's always like, if you're going to sell and take the money, it's usually 50% of anything you're taking is going to that tax man. Like, usually that's what we're like,
when you add in the recapture and the little,
all the things.
It's a good rule of thumb to be conservative.
It's conservative.
It's conservative. And it truly is. It's going to be 30 to 40%. And if you just tell them, hey, just figure half. That's very good. Yeah,
which nobody wants to pay 50% conservatively to the tax man, which is the whole point.
Well, you're wiping out your equity.
Yes.
Yep.
Like there it goes.
We're the term that I've picked up from one of our clients that I love is we have an extreme aversion to paying tax.
That's right. Yes.
And so it's like we're going to find every little crevice of loophole and way, and then we're like, well, we'll just keep sharpening our ability to use 1031s, use depreciation, and use all these tools. And we plan to defer for our entire life.
Exactly.
The only thing that'll kick us off that and change our plans is like if they remove the 1031 or something of that nature.
Yeah, that would take something super drastic. But
I mean, it's been around for years. How many years has the 1031?
It's been over 100 years now.
Okay.
Oh, wow.
And this is how all the wealthy families and politicians are transferring generational wealth. Yes. So the likelihood of it happening is slim to none in reality.
How long do you think the new bonus depreciation laws will stay in effect? I know that currently they don't have a time frame or a fuse.
Right.
They're not set to expire in 5 years like the first round. So do you think the bonus will stick around?
In the current environment, I have a hard time predicting how things might look from one day to the next sometimes. Mm-hmm. But I think that is the intent. Hopefully that should stick around for a while. Who knows what some future administration or something else might do with it. But it was had been phasing out. And now that it's been brought back, it's just a huge part for any investors, anybody with income that they need to offset some tax bill.
Have you noticed an increase in your business or volume since that tax code's been put back in place?
We get a lot of questions about it. And what's interesting on our side, what they actually end up doing if do they get the cost seg study and do the bonus depreciation on their taxes? We don't always see that part. So how many are actually doing it is hard for us to really put our finger on and get an actual number.
Sure.
But it has raised a lot of awareness for sure.
Yeah.
And we've been able to talk about it a lot more and get the word out there. Yes, absolutely.
Yeah.
So something I would love your input on. We ended up selling against DSTs.
Oh, right. Okay.
Oh, yeah.
And so what do you know about, and do you guys help the DST guys, or how does that work for you guys?
Good question.
Yeah.
So it goes back to somebody needing a fallback option.
Yeah.
Right. So we don't push DSTs. We don't sell them. We'll make people aware that it's an option. And so we have plenty of DST sponsors calling us all the time, thinking we just have buyers like falling out the sides of the money and, hey, send them over. We can do all these DSTs. So we don't do any recommendations at all. We stay out of that. That's not our lane. But it's as far as people needing options to put on their list, we can throw it out there. Hey, you can do DST, you can do oil and gas, you can do triple net lease properties, you can do different investments, right? You can do TIC investments.
And it still is that like kind. It falls into the category of like that satisfies the exchange.
That's a great question. You know why? Because I get these all the time. That's another Google answer that people get. They say 1031 exchange, and then it says like kind exchange. Well, they just assume what that means.
Yeah.
And so I've had people selling a duplex telling me, well, we're not going to exchange now. We're not going to find another duplex in the area or one that we like. And they're thinking like kind means same property.
Right.
And they're missing that whole point. It just means investment property for investment property. As long as it's investment property, it doesn't matter the type.
Exactly.
So you can go into all these other, and that's why you have the TIC investments. That's why you have the DSTs. That's why you have, all these different setups.
Yeah.
That is still investment property. And you can do multiple of them. And it goes back to the boot, discussion we had as well. So if somebody is ending up with extra boot, we'll tell them, well, wait, why don't you just buy a second property?
Exactly.
Or invest it into something. Like why
get the money moving and then use depreciation, and you can you could probably offset the boot, especially if it's small enough. Yeah,
absolutely.
And maybe you only click through with a little bit of California tax or something like that.
Right.
But yeah,
there's so many ways to skin that cat. That's why it's the
term we got from our old CPA who was at EY was don't let the tax tail wag the dog.
Exactly.
Like sometimes you're like, you can't get a perfectly airtight 1031. It's like you're going to have maybe 20, 50, 100 grand that ends up after. And you can always trim the loan. If you have a loan, you can always trim loan back.
Right.
I think that's something that people don't think about. Lenders will always take loan proceeds off. And you can then fund. But if you have to, lenders will accommodate the boot dynamics. I've had several lenders tell me, hey, just tell me what you want to close at. Your loan approval's at, let's say, 10% more. So we'll close at the lower loan approval and then just fund the additional proceeds post-closing, and that's no boot. So then you can end up with some refinance proceeds, which is not taxable, to then complete your CapEx or whatever you're looking at.
That's exactly it. And we're always explaining that as well. Well, how do we ever if we're only deferring tax, how do we ever get out of this? They think that, it's going to come calling at some point. I just told them we'll never sell without exchanging. That settles it.
It's just called defer for life.
Just defer for life or swap till you drop. That's that's a technical term.
Till you drop.
The swap till you drop strategy. Well, and then when you do pass along and your heirs inherit, they're going to get the stepped up basis, and that's when that tax goes away. But in the meantime, you do strategies like that. You put money in, defer it all, and then take money out of the property if you can, or take a little bit of boot, like you're saying. Take a little bit of boot. Just pay tax on that.
Well, and sometimes, that's a big difference. Only a little bit of boot or a little bit of tax owed is way better than whatever you would have owed after taking it without doing the exchange.
That's
so
exactly
it makes a lot of sense. And our tax guy who said that was totally right, because it's not a perfect, especially
it's pretty tough to hit them perfect.
It is.
Like we've gotten good at it because what we're doing is just adding additional fresh cash from investors. So we're always buying way bigger. Typically we'll sell like a $3 or $4 million asset and buy a $10 or $20 million asset. So then it comes in as a small tick, tenant-in-common owner of that larger asset. And we just make sure that the purchase price allocation is correct. So then it's easy enough for us to use the toggles to make it clean.
Yeah.
Mm-hmm.
But when you're doing one for one,
it's hard.
It's hard. The first few we did, we ended up with a few $100,000 to boot here and there.
Oh, really? Yeah.
But on like multi-million dollar transactions.
Yeah, sure.
So,
right. Yeah.
But then you go in, you get to do the new depreciation schedule, the new cost seg.
Right.
And then that goes through the boot dynamic and that additional, it ends up to our limited partners, it ended up being pennies.
Yeah, that's what's great about that.
And they don't even feel it because it goes pro rata and it's so little when it's broken down pro rata share. Yeah.
That's what's so great about that. And having the specialists lined up that know that and can explain it and break it and do it for them.
Yeah.
And realizing, okay, you do have some boot, but you're not going to have tax because you can still do this. Yeah, that's just amazing that you have all the models set up for them to do that.
We do need more people like you, though. So why don't we wrap up on that? If you're looking at selling something in the residential or investment space and you're looking to do a 1031 exchange, call a 1031 specialist and ask for Aaron and he'll dial you in.
Appreciate it. Yeah. Look forward to helping and working with you guys. Helping any of your clients have questions. Yeah. I just love consulting and getting in there. I'm the same way. It's that tax aversion. It hurts me when I hear these stories of somebody paying these tax bills.
Me too.
It just crushes me.
We hate taxes.
Amen. Amen. I don't want to pay tax.
No.
I want that money to build and spool and not have
keep it compounding. Yeah.
Exactly.
The first rule of compounding is never stop it.
That's right. I love that. Yeah. Well, thanks for being here. This was fun talking with you. I think we gave our listeners a lot of good nuggets today. So
I appreciate it. Thanks for inviting me in. I had a great time as well.
Great to have you. All right. See you next time on the Cashflow Quest. Thanks for joining us, and I hope you got a lot out of this.